You check your credit score for loans, for mortgages, even for some jobs. But did you know that number also determines how much you pay for car insurance? Even if you have a perfect driving record, a driver with excellent credit and a few tickets can pay less than a driver with poor credit and a spotless record. That is not a hypothetical. That is how the system actually works. And here is the part that should make you angry. In most of the country, insurance companies can check your credit without your permission, use a secret scoring formula you cannot see, and raise your rates by over $1,000 a year based purely on a number that has nothing to do with how you drive. By the end of this video, you will understand exactly why your credit score affects your car insurance, how insurance companies get away with it, and the legal loopholes you can use to fight back. I will break down the difference between your regular credit score and your insurance score, reveal the states where this practice is banned, and give you a step-by-step action plan to improve your insurance score faster than your regular credit score. This is not about fixing your credit overnight. It is about understanding a system designed to hide from you. Let me start with the most important distinction that almost no one knows. Your credit score and your insurance score are not the same thing. When you check your FICO score on Credit Karma or your bank app, you are seeing a number designed to predict whether you will pay back a loan. That number ranges from 300 to 850. Your insurance score is different. It is a specialized calculation designed by insurance companies to predict how likely you are to file a claim that will cost them money. Insurance scores can range from 200 to 997, depending on which scoring model the insurer uses. And they weigh certain factors differently than a standard credit score. Here is how the weighting breaks down. Payment history makes up 40% of your insurance score. That is even higher than the 35% it represents in your regular FICO score. Outstanding debt makes up 30%. Credit history length makes up 15%. The remaining 15% comes from your pursuit of new credit and your credit mix. Notice what is missing. Your income does not appear. Your job does not appear. Your driving record does not appear. The insurance score is purely based on your credit behavior, and it is designed specifically to predict something you have never agreed to be judged on: your likelihood of crashing your car. Now here is where the legal loophole comes in. The Fair Credit Reporting Act, a federal law, gives insurance companies what is called a permissible purpose to look at your credit information without your permission. That is right. They do not need to ask. They do not need you to sign anything. They can pull your credit report the moment you request a quote, and they can use that information to set your rate. In most states, there is no law stopping them. The only thing they cannot do is use your actual credit score from FICO or Vantage Score. They have to use their own proprietary insurance scoring model. But the underlying data is the same: your payment history, your debt levels, your credit age, all of it. And here is the pattern interrupt that most agents will never tell you. Insurance companies do not just check your credit when you first apply. They can check it again at every renewal, sometimes without notifying you. If your credit score drops because of a missed payment or a medical bill you did not know about, your insurance premium can go up at the next renewal. You have done nothing wrong on the road. No accidents, no tickets, no claims. But your rate increases anyway. That is the hidden cost of credit-based insurance scoring. Let me break down the states where this is banned or restricted, because this is where you have real power. California, Hawaii, Massachusetts, and Michigan have completely banned the use of credit-based insurance scores for auto insurance. If you live in one of those states, Your credit score does not affect your car insurance rate at all. California banned it years ago, and insurers in California simply do not use credit history for underwriting or rating auto policies. In Maryland, Oregon, and Utah, there are also significant restrictions, though the rules vary by state. In every other state, insurers are legally allowed to use your credit information to set your rates. But here is where it gets even more complex. Even in states that ban credit scoring for auto insurance, some of those same states allow it for homeowners insurance. So you could have one rule for your car and a completely different rule for your house. And in states that allow it, insurers can use credit scoring as long as they follow certain disclosure rules. Some states require insurers to tell you if your credit score negatively affected your rate. Others do not. Some states require insurers to re-evaluate your rate if your credit improves. Others leave it up to you to ask. Let me give you a real example of how much this matters. According to industry data, a driver with poor credit can pay up to 91% more for car insurance than a driver with excellent credit, even with the exact same driving record. Same car, same age, same zip code. That is nearly double. In dollar terms, that can be over $1,500 per year. For a family with 2 cars, that difference can exceed $3,000. All based on a number that has nothing to do with how safely you drive. Now let me tell you about the legal battles happening right now. In 2025, the Prohibit Auto Insurance Discrimination Act, also called the PIDE Act, was reintroduced in the U.S. House of Representatives. This bill would ban the use of non-driving related factors like credit scores, occupation, education level, and employment status in determining auto insurance premiums. The bill is still working its way through Congress, but it has bipartisan support. At the state level, Michigan continues to allow insurance companies to impose the highest credit score penalties in the nation on safe drivers, according to testimony delivered to state lawmakers. New York, Illinois, and South Carolina have all introduced bills to limit or prohibit the use of credit scoring in auto insurance. The fight is ongoing, but for now, in most states, credit scoring is still legal. So what can you do about it right now? Let me give you a 5-step action plan. Step 1. Find out if your state allows credit-based insurance scoring. If you live in California, Hawaii, Massachusetts, or Michigan, your credit score does not affect your car insurance. If you live in Maryland, Oregon, or Utah, there are restrictions but not a full ban. For everyone else, your credit matters. Knowing this will tell you where to focus your energy. Step 2. Get your free credit reports. You are entitled to one free credit report from each of the 3 major bureaus every year at annualcreditreport.com. Pull all 3, look for errors. Dispute anything that is incorrect. Even a single wrong late payment can drag down your insurance score. Requesting your own credit report does not hurt your scores, so do it today. Step 3. Check your insurance-specific data reports. LexisNexis is a consumer reporting agency that collects data specifically for insurance companies. They have something called a CLUE report, which shows your claims history, and a LexisNexis Attract Insurance Score, which is a credit-based score used by many insurers. Under federal law, you can request one free copy of your LexisNexis consumer report every 12 months. Review it for errors. If you find mistakes, dispute them. LexisNexis also allows you to freeze your report, which can prevent insurers from accessing it. Step 4. Improve your insurance score using the correct weightings. Since payment history is 40% of your insurance score, focus there first. Pay every bill on time, every single month. Set up automatic payments for the minimum amount so you never miss a due date. Next, reduce your outstanding debt. Insurance scores weigh your current debt levels at 30%, so paying down credit card balances can have an immediate impact. Aim to keep your credit utilization below 30% of your available credit. Lower is even better. Third, do not close old credit accounts. Credit history length is 15% of your score, so older accounts help you. Keep them open even if you do not use them. Fourth, avoid opening multiple new credit accounts at once. Each application temporarily lowers your score, and insurance scores weigh new credit applications. Spacing out applications by 6 months or more can help. Step 5. Shop around aggressively. Different insurance companies use different credit scoring models and weigh factors differently. One company might penalize you heavily for a single late payment. Another might be more forgiving. The only way to know is to get quotes from at least 3 to 5 insurers. If you have poor credit, look for companies that specialize in non-standard insurance or that offer telematics programs. Usage-based insurance programs track your actual driving behavior, not your credit. If you drive safely, you can earn a discount that bypasses your credit score entirely. Let me also address the differences in Canada and the UK, because this is not just an American problem. In Canada, credit scoring for auto insurance varies by province. Ontario and Newfoundland and Labrador have banned insurance companies from using credit scores to set premiums. In other provinces, insurers are generally allowed to use credit information, but they must obtain your explicit consent before conducting a credit check. This is different from the US, where insurers can check without permission. In Canada, if you say no, they cannot access your credit. However, they may also refuse to give you a quote or charge you a higher rate based on other factors. The Insurance Bureau of Canada has a code of conduct for insurers using credit information, but enforcement varies. In the UK, the rules are different again. UK insurers typically do not check your credit score when you get a quote. Instead, they check your credit if you choose to pay for your insurance in monthly installments rather than upfront. Paying annually avoids the credit check entirely. Studies show that poor credit can increase annual insurance costs by 20 to 50% compared to very good credit. But the impact is less direct than in the US because the credit check is tied to the payment method, not the insurance itself. If you have poor credit in the UK, pay your annual premium in full upfront to avoid the credit check and the potential surcharge. Let me give you a real-world example of how fixing your credit can lower your insurance costs. A driver in Texas named Carlos had a credit score of 580, primarily due to high credit card balances. His car insurance premium was $230 per month. Over 6 months, he paid down his balances from 90% utilization to 25% utilization. His credit score improved to 670. He called his insurer and asked for a rate review. His new premium was $160 per month. That is a $70 per month drop, $840 per year. He did not change his driving. He did not change his car. He just improved his credit, and he asked for the review. His insurer did not offer it automatically. That last point is critical. Insurance companies are not required to automatically lower your rate when your credit improves. In most states, you have to call them and ask for a re-evaluation. So if you have been working on your credit, make that phone call. Say, "My credit has improved since I first took out this policy. Can you rerun my insurance score and adjust my premium?" Some insurers will do it immediately. Others will require you to wait until your next renewal. But if you never ask, you will never get the savings. Let me recap the key takeaways. Number 1, your insurance score is different from your regular credit score. It weighs payment history at 40% outstanding debt at 30%, and credit history length at 15%. Number 2, the Fair Credit Reporting Act gives insurance companies a permissible purpose to check your credit without your permission in most states. Number 3, California, Hawaii, Massachusetts, and Michigan have banned credit-based insurance scoring for auto insurance. If you live there, your credit does not affect your car insurance. Number 4, in most other states, poor credit can increase your premiums by up to 91% compared to excellent credit, which can be over $1,500 per year. Number 5, you can request your LexisNexis Consumer Report for free once a year and dispute any errors. Freezing your report can also prevent insurers from accessing it. Number 6, improving your payment history and reducing your credit utilization are the most effective ways to raise your insurance score. Number 7, if your credit has improved, call your insurer and ask for a rate review. They will not do it automatically. Number 8, in Canada, Ontario, and Newfoundland and Labrador, ban credit scoring for auto insurance. In other provinces,